Hello, my name's Johnny Mullett. I am a financial advisor at Carpenter Box Financial Advisers. I'm here to talk briefly about the announcements made in the budget on the 30th of October 2024. From the advisor's perspective, there were a number of announcements, mainly surrounding the liability with inheritance tax. And there are now a number of products that will fall within that scope. And the one that is probably most common for people is the effect of their pension values now being part of their estate for inheritance tax purposes. So the announcement is made and is set to be in place in 2027, although it is under consultation currently. But if going through, it states that any unspent pension value will form part of the estate for potentially being liable for inheritance tax. And as a reminder, you are able to pass on wealth up to your nil rate band without inheritance tax due. Any value, which will now include your pension value, will be in addition and calculated in excess of that, and as such, could incur inheritance tax, which is currently at a rate of 40%. So this would be quite a big change for clients, where they are now viewing their pensions more of a legacy objective as opposed to a retirement income objective. So there'll be a number of pieces of work that we would look to work with clients on with respect to managing this new position. This could be withdrawing money from your pension to gift when you're alive, or it could be possibly using vehicles such as an annuity to generate retirement income and not have a pension value with that action. So that will be something that we'll be looking at for clients and no doubt discussing further. Similarly, in the same vein of inheritance tax planning, there is additionally a change to assets which qualify for business relief. So this is typically used again for inheritance tax planning, whereby a client might have wealth without outside of the sort of means in which they need to generate income, but rather they're looking to pass on wealth to their loved ones in a tax efficient manner. And what typically has been the case is that unlisted shares, so these are shares that could be listed on the AIM market, the alternative investment market. These previously had qualified for business relief at 100%. Now the announcement is that the business relief will be 50%, meaning that the inheritance tax due on shares that are unlisted will now be 20%. So that's inheritance tax being a rate of 40%, so 50% relief, meaning there'll be a tax rate effectively of 20%. Again, this is something that clients will need to understand and address, especially if they've already got some of these in place, to now understand, what is going to be the liability for them in with that type of asset, because that type of asset previously has been free of inheritance tax. So yeah, please do contact us if you want to discuss that further. No doubt we will be contacting you if we are aware that you have a similar position. And I think lastly, with the capital gains tax announcement, so now the rates of tax with respect to capital gains are now in line with what they are with investment property. So the lower rate of capital gains tax, so gains that fall in your basic rate threshold, will now have a capital gains tax of 18%, and the higher rate capital gains tax, so gains that fall in above your basic rate threshold, this is going to run you a capital gains tax rate of 24%. So these are higher than what they were previously. And so where you've got possibly shares that you own that you're thinking to sell, where you've got maybe general investment accounts with funds that have gains, it's going to cost you more in taxes potentially when you come to dispose of these assets. So possibly what's worth considering if you now have a sum of money that you're thinking about investing, you know, is it going to be in your interest to continue investing in assets that produce gains? Or could we think about possibly using different products which generate income and gains, which would be classed as savings or non-savings income? So they have, the income rate taxes as opposed to the capital gains taxes. This may be an open door for people, but I think it's on a case-by-case basis. The capital gains tax rates are still lower than income tax rates, but possibly there's some allowances that could be used to maybe tip the scales on the other side. So yeah, this is also something to be thinking about. But as a summary, I think the main announcements that I think will impact clients most is having a better understanding about their inheritance tax position now that pensions are going to be within the scope of it if the consultation goes through and it is in place in 2027. I strongly suggest that you do contact your advisor to speak on this further, as this is a relatively big change, albeit nothing to completely panic about. We just need to discuss how that impacts you and if it does even impact you. So yeah, please do contact us if you are seeking some guidance. The best place to find us would be our website, so carpenterboxfa.com. There you'll find information about the budget and other things, but also our contact details to book in a meeting or a telephone call. I hope that helps, and yeah, have a great day.